All right, 8.3, corporations and other organizations. It's the end of our unit on businesses, or our chapter on businesses. So we've got 3 learning objectives. First, we're going to describe how a corporation is established, and then understand why large businesses favor the corporate form. And finally, recognize other types of businesses, business organizations. It's sort of like the leftovers, it's 5 different types of hybrids that they really can't categorize as a strict partnership, sole proprietorship, entrepreneurship, or corporation. So first of all, incorporating. So a corporation is a legal entity with an existence distinct from the people who organize it, own it, and run it. So that just means that it's sort of, you can think of it as, a separate person, because a corporation can earn a profit, a corporation can lose money, a corporation can actually be sued, and a corporation can be found guilty of a crime. So let's just be crazy and throw one of the corporations that we're all pretty well familiar with in that statement. So, for example, Walmart earns a profit. Walmart loses money. You can actually sue Walmart, and Walmart can be found guilty of a crime. So it's a legal entity distinct from the people who organize it and own it. An example of corporations, comparing them against partnerships and sole proprietorships, all the businesses in the U.S., corporations are just 18.3%. Sole proprietorships are more. We have more sole proprietorships in the U.S. than we do corporations and partnerships. But if you look at how much money they make, so a share of business sales, how much money they make, corporations are only 18% of all businesses in the U.S., yet they make 82% of all business sales, all of the money that is made in the U.S. Most of it's a corporation. A sole proprietorship is 72% of all the businesses in the U.S., yet they only make 4% of the money that is made in sales in the U.S. Distribution of corporations by annual sales. So these are corporations. The biggest piece of the pie, they have an annual sales of $100,000 to $499,000. That's the biggest piece of the pie. It's not a ton of money. Here we have $1 million or more, 9.2%. This is where you've got Tyson and Walmart and J.B. Hunt, the big corporations that are making a lot of money. But the biggest piece is $100,000 to actually $500,000. And then industry. How are corporations separated by industry? The biggest piece is services. The smallest piece being manufacturing. Actually, agriculture is the smallest piece, especially in a corporation. There's not a lot of agriculture in corporations. Most of those are, personal or sole proprietorships and farmers. So, articles of incorporation. When you want to become a corporation, you establish your corporation through articles of incorporation, and that is a written application to a state seeking permission to form a corporation. If these articles comply with state and federal laws, a charter is issued and the corporation becomes a legal entity. A charter offers the legal authorization to organize a business as a corporation. So once you have a charter, so you fill out an application, you write an application to the state seeking permission, and then you get a charter. Once you've completed that, you can start electing a board of directors. Board of directors is elected by stockholders in the corporation to oversee the firm's operation. The board of directors can set corporate goals, decide major policy issues, appoint and set salaries for top officers. They keep everything in line. They keep everyone in check. And that's elected by stockholders. So we've learned through the stock market curriculum that stockholders are actually owners of the corporation. They all own a piece of the corporation. Owners of the corporation are issued shares of stock, and that entitles them to corporate profits, either in dividends or just as the stock increases, they're sharing in the profit, and voting privileges. Dividends are a share of profits a corporation pays to its stockholders. Not every corporation pays dividends, but a lot of the bigger corporations do. There are two types of corporations, a private corporation and a publicly traded corporation. Private ones issue stock to just a few people, sometimes only family members. A publicly traded corporation has many stockholders, sometimes millions, who buy and sell shares on the stock exchange. Private corporations do not use the stock exchange. Public ones do. Publicly traded corporations are much larger than private corporations. And publicly traded corporations account for less than 1% of the 6 million U.S. corporations. So if we went back here to... So corporations, these are all corporations. Only 1% of them are publicly traded, is what it said. Let's get back there. Yep, publicly traded. So if we look, even here, corporations are only 18% of all business types in the U.S. 1% of this piece of pie are publicly traded corporations. That's pretty small when you think about how many corporations there are. We also have advantages and disadvantages of corporations. First of all, advantage, they're easier to raise financial capital. Investors can exchange their money for company shares, giving the firm a huge pool of funds. That's what we did in the stock market game. We invested in companies, giving them money to invest in themselves. There's limited liability. Worst case scenario, stockholders will only lose just as much as they invested in the company. They are not liable past their investment. If you remember back to sole proprietorships and partnerships, the liability falls back on the sole proprietor. If something goes wrong with the company, if they make poor decisions, they could lose their home, they could lose their car, they could lose all of their savings because they're liable for anything that the company does. In a corporation, there's limited liability. So stockholders are the owners, but they're only going to lose what they invest. They will never lose more than they invest. If something happens with a huge corporation, the stockholders, will not lose their house, they'll not lose their car, they'll not lose their life savings. An advantage is unlimited life, where a sole proprietorship, the life of the company rests in the owner and the individual who's in charge of the company. So the life of a sole proprietorship is limited. Here it's unlimited. The corporation does not cease to exist if a major stockholder dies or leaves the business. The corporation does not cease to exist if a board member passes away. Specialized management. Ownership is separated from management. A corporation can hire experts to manage the firm, which is important. We own stock in a few companies, and I have nothing to do with the management of those companies. Disadvantages. It's very difficult and costly to start. The most complicated to start. Articles of incorporation can be very difficult and costly to draw up and get approved by government officials. Corporations are more regulated, especially if they're publicly traded. There are a lot of regulations in what a corporation has to report to its stockholders and to the public. So the corporations also face more regulations and red tape than other forms of business. Owners have less control. Owners are the stockholders. We don't have very much control. Stockholders are far away from the daily operations of the business. They have little direct control over the corporation. Professional managers run the business. Double taxation. So an advantage of a sole proprietorship, if you remember, is you're only taxed once. On the income that is made from the company, the sole proprietor is only taxed once for every dollar they make. A corporation actually gets taxed twice. The government looks at a corporation as a legal entity separate from its owners. The corporation pays taxes on earnings, and the stockholders pay personal income tax on earnings. Therefore, each dollar a corporation earns gets taxed twice. It gets taxed once to the corporation and once to the owner. Lastly, other organizations. We have hybrid businesses, S corporations, limited liability company, limited liability partnership, cooperatives, and not-for-profit organizations. This table breaks it down very, very well. Or in the textbook on page 255, there's a lot of information about each specific company. Just to give you a few highlights. If you look at, these are called hybrid businesses. A hybrid business it takes advantage of, some sole proprietorship stuff that we really like, some advantages of being a sole proprietor and some advantages of being a partner, some advantages of being a corporation. So some new business hybrid organizations offer the protection of limited liability while avoiding the double taxation of business income. S corporation, that was introduced about 30 years ago, combines limited liability protection of the corporate form with the single taxation feature of a partnership. But to qualify as an S corporation, you have to have no more than 100 stockholders and no foreign stockholders at all. Then you have limited liability companies, combines the limited liability feature of the corporation with the single tax provisions of a partnership. Company owners are called members, not partners or shareholders. You have limited liability partnerships. An LLP has the advantages of an LLC and is easier to establish, especially if a business needs to convert from a regular partnership. And then you have a cooperative. It's a group of people who pool their resources to buy and sell more efficiently than they could independently. That's sort of like Ozark Natural Foods down in Fayetteville. And then not-for-profit organizations. They engage in charitable, educational, humanitarian, cultural, professional, and other activities, often with a social purpose. Government agencies do not have profit as a goal either, but governments are not included in not-for-profit organizations. Review this chart here. It's what you're responsible for, and it should give you all the information you need.